Well, the Asian markets, they're more or less mixed in early morning trading session. The Nikkei, that's up close to around 2.5% in this week itself. But today, it's just holding with a marginal gain of around 0.1%. Remember, high-level trade negotiations between China and the United States, they're underway in Washington. So that's really going to be the focal point. And what's the outcome out there? Otherwise, the Kospi had opened up in the green. That's holding more or less flattish. The Straits, that had opened up in the green. In fact, the last time I checked, that was up close to around 0.3% odd. So that one as well should come up for you, while the Taiwanese index mildly in the green. So more green than red actually in early morning trade, and that explains why the SGX Nifty as well is indicating we're likely to start off in the green with a gain of around 20 points. Remember, yesterday we saw a sharp correction from the highs of the day, so good to see some green to kickstart trade.
All right, so that was all of the action from Asia, but let's also take a look at how the US markets fared. Wall Street ended higher, though off their intraday's highs, as investors reacted to upbeat comments on the US-China trade talks. Markets were, however, weighed down by softer US services and private payrolls data. Now, the Dow Jones climbed around 40-odd points. The S&P 500 gained just around 0.2%, but notching its 5-day winning streak now, while the Nasdaq moved 0.5% higher. CNBC's Josh Lipton now gets us a wrap of everything that transpired on Wall Street. Josh.
U.S. stocks finishing higher. The Dow up 39, the S&P adding 6, and the Nasdaq higher by 46. Private payrolls posting a disappointing month in March, increasing by 129,000, according to ADP and Moody's Analytics. That's well below economists' expectations of 173,000. March coming in as the worst month for private payrolls since September 2017. Weekly mortgage refinances spiking 39% after the biggest one-week drop in mortgage rates in a decade. Refinance applications jumping to the highest level since January 2016. And Verizon beginning to roll out its 5G wireless network for smartphones in Chicago and Minneapolis. Verizon CEO Hans Vestberg telling CNBC the company will activate its 5G networks in 30 more markets this year. That's the action from the U.S. market. Now back to you in Mumbai.
All right, thanks a lot for that, Josh. But on that note now, here is some opinion from experts on the U.S. market and also the triggers for the market going forward.
The yield curve, which everybody was stressing about, may not invert as the bond yield maybe goes closer back to 3%, because the economy is doing better. Not that inflation is coming back, but look, I think we are going to get a China deal, and I think we're going to get what I call a peace dividend. The global economy has been held back by the uncertainty of the tensions between China and the U.S. Put that behind us, and I think the global economy may also start to show some signs of improving. Inflation's dead, and it's been killed by all sorts of things like aging demography around the world, and too much debt is actually not being stimulated, it's actually weighing on economies. And then technological disruption is a big issue. So central banks, I think, have managed to offset deflation rather than bring back inflation, and so the bond vigilantes have been pretty relaxed.
I think the markets have basically priced in some sort of resolution to trade. I think what's been moving markets more recently has obviously been the dovish shift at the Federal Reserve last month, but more importantly, some signs that there are green shoots emerging with respect to global growth. You know, the China PMIs looked a little bit better. The European manufacturing PMIs still don't look great, but the services side of the equation is improving. The U.S. numbers are getting a little bit better. Retail sales, durable goods, right, all showing some signs of life. And I think when you look at where the first quarter could shake out and where we may be headed for the rest of the year, things just aren't looking quite as dour as they did back in December.
Well, in the European markets, they closed higher. Investors out there monitored signs of progress in terms of the US-China trade talks. In fact, the DAX, that was a big outperformer. That was up more than 1.5%. But the FTSE, that's been in focus, and that's on the back really of Brexit trade talks. And in the UK Parliament, in fact, the Brexit deadlock continues. Speaker John Bercow has blocked further indicative votes on Brexit options, and the Parliament has passed a law forcing Prime Minister Theresa May to seek another Brexit delay and rule out a no-deal departure.
All right, let's also look at the currency space now. The dollar index eases versus the basket of other major currencies, while the Japanese yen remains range-bound versus the US currency. All right, in the world of commodities also, crude oil prices slipped after touching $70 a barrel following a surge in U.S. crude stockpiles. Meanwhile, like OPEC cuts and U.S. sanctions on Iran and Venezuela also support prices.
Well, the big event today for the Indian market is the Reserve Bank of India's monetary policy. The central bank will announce its first rate decision of FY20 today at 11:45 a.m. Now, 100% of the market participants and economists that were polled by CNBC-TV18, they're expecting a 25 basis repo rate cut. Ritu Singh is with us to run us through the details of the monetary policy survey.
It looks like the Reserve Bank of India is set to cut rates for the second consecutive time, given the continued downward surprises on retail inflation front, broadly anchored commodity prices, subdued domestic growth indicators, and a benign global monetary policy backdrop. Now, all the respondents to the CNBC-TV18 poll expect a 25 basis point rate cut from the MPC in its first bi-monthly monetary policy. 60% of the respondents, in fact, go on to say that including the April policy, the RBI will cut repo rates by 50 basis points through the calendar year, and a handful even expect rates to be cut by 75 basis points in 2019. On the growth front, the respondents largely expect the projections to be lowered. This is because of the high-frequency indicators continuing to point towards a cyclical slowdown and lower private consumption, which is likely to keep domestic growth muted. Now, 73% expect the 7.3% forecast for Q3 FY20 as well as the 7.2 to 7.4% range for the first half of FY20 to be lowered. On the retail inflation front, which continues to be below the 4% targeted by the RBI, in fact, in the last reading, it was below 3% even. Here, the expectation is that the inflation projections may not be lowered just yet, especially with monsoons round the corner, which could significantly impact the food prices. Therefore, 60% of our respondents expect the 3.2 to 3.4% projection for CPI inflation for the first half of FY20 to be left unchanged, and 80% expect the Q3 forecast to also be left unchanged. Now, as core inflation has remained sticky, that is the problem that continues to mount. Now, the stance of the RBI is also expected to be maintained in the neutral mode, and the tone could be more or less similar or more dovish compared to the last policy, given the growth and inflation dynamics.
All right, thanks a lot for that, Ritu. But time for a quick break now. Up next, all of the cues and news you need to know for trade this morning.